Benjamin Graham is widely regarded as the father of value investing, and his book, The Intelligent Investor, remains one of the most influential financial books ever written. Originally published in 1949, this work has stood the test of time and continues to be essential reading for anyone looking to navigate the world of investing with wisdom and discipline. Unlike many financial books that focus on speculation, short-term trading, or market predictions, The Intelligent Investor provides a long-term, rational framework for wealth accumulation. Graham's principles are built on the foundation of logic, patience, and a strict focus on the intrinsic value of assets rather than their market price at any given moment. His approach has shaped generations of successful investors, including Warren Buffett, who credits Graham as his mentor and describes The Intelligent Investor as the best book on investing ever written. The book's central premise is that financial success is not about predicting market movements, but about adopting a disciplined, analytical approach that minimizes risk while maximizing the potential for reasonable, sustainable returns. One of the fundamental distinctions Graham makes in the book is the difference between investing and speculating. He emphasizes that true investing involves a thorough analysis of a company's financial health, the preservation of capital, and the expectation of an adequate return. Speculation, on the other hand, is characterized by attempts to profit from short-term market fluctuations, often driven by hype, emotion, or herd mentality. To illustrate this point, Graham provides historical examples of speculative manias, such as the 1929 stock market crash, when millions of investors lost their fortunes by chasing rising stock prices without considering their underlying value. He warns that markets will always experience cycles of euphoria and despair, but a rational investor must remain unaffected by these emotional swings. For example, during the dot-com bubble of the late 1990s, countless investors poured money into internet startups with no earnings or revenue, simply because their stock prices were skyrocketing. When the bubble burst in 2000, most of these speculative investments evaporated, wiping out trillions in market value. Graham's advice remains timeless. Instead of following market trends or stock tips, investors should conduct independent research, focus on fundamental analysis, and only invest in businesses that demonstrate sound financial health. One of the book's most important concepts is the margin of safety, which Graham considers the cornerstone of intelligent investing. The margin of safety refers to purchasing securities at a significant discount to their intrinsic value, providing a buffer against potential mistakes in judgment, economic downturns, or unforeseen business challenges. Graham argues that no investor can predict the future with certainty, so a margin of safety acts as an insurance policy against unexpected negative events. For example, if a company's calculated intrinsic value is $100 per share, but its stock is trading at $60, this creates a 40% margin of safety. Even if the company experiences temporary setbacks, the investor is still likely to achieve a positive return over the long term. A classic example of this principle in action was during the 2008 financial crisis, when high-quality companies like Johnson & Johnson and Procter & Gamble saw their stock prices plummet due to market panic. Investors who applied Graham's principles and bought these stocks at depressed prices benefited enormously, as their intrinsic value remained intact and their stock prices recovered in the following years. Graham repeatedly stresses that buying stocks with a margin of safety is the best way to protect one's capital, while allowing for future growth. To help investors manage their emotions and make rational decisions, Graham introduces the famous metaphor of Mr. Market, a fictional character who represents the stock market's unpredictable and often irrational behavior. Mr. Market is your business partner who offers to buy or sell shares every day, but his mood swings wildly. Sometimes he is overly optimistic and willing to pay exorbitant prices, while other times he is pessimistic and offers to sell his shares at a steep discount. The key takeaway is that investors should not let Mr. Market's emotions dictate their decisions. Instead, they should capitalize on his irrationality by buying when prices are low and selling when prices are high. For example, during the COVID-19 market crash in March 2020, stock prices of solid, profitable companies plunged as panic gripped investors worldwide. A rational investor following Graham's philosophy would have recognized this as a buying opportunity rather than a reason to panic. This is why Warren Buffett often advises, be fearful when others are greedy, and greedy when others are fearful. A direct application of Graham's Mr. Market analogy. Another crucial aspect of intelligent investing, according to Graham, is diversification. He advises investors to avoid concentrating too much capital in a single stock, industry, or asset class, as this increases risk exposure. Instead, he recommends spreading investments across different sectors and security types to create a balanced and resilient portfolio. A defensive investor, for example, might allocate 50% of their capital to stocks and 50% to bonds, adjusting the proportions based on market conditions. Graham explains that stocks offer higher long-term returns, but bonds provide stability and income, making them an essential component of a well-diversified portfolio. He also warns against putting too much faith in growth stocks that promise rapid appreciation. A striking example of this can be found in the 1970s Nifty 50 era, when investors flocked to stocks like Xerox, Polaroid, and IBM, believing they could only go up. However, many of these high-growth stocks eventually collapsed when expectations proved unrealistic. Graham's approach would have prevented such losses by emphasizing diversification and a focus on valuation rather than speculation. One often overlooked but critical lesson from the intelligent investor is the power of financial discipline and conservative forecasting. Graham warns against assuming that past growth rates will continue indefinitely and advises investors to be cautious with companies that seem too good to be true. He argues that businesses operate in cycles, and even the most successful companies can experience downturns due to external factors such as industry changes, regulatory shifts, or economic recessions. For example, General Electric was once considered one of the safest blue-chip stocks, but over time, its debt burden and strategic missteps led to significant declines in its stock price. Graham teaches that instead of blindly trusting a company's past performance, investors should examine its financial resilience, balance sheet strength, and ability to generate consistent cash flow. He also cautions against excessive leverage, explaining that debt-fueled growth often collapses under financial pressure. The 2008 financial crisis serves as a powerful example of this principle, as banks and financial institutions that overextended themselves with risky debt suffered catastrophic losses, while companies with stronger balance sheets weathered the storm more effectively. Another fundamental insight from the intelligent investor is the distinction between different types of stocks and investment approaches. Graham differentiates between defensive stocks, which are suitable for conservative investors, and more aggressive investments that require active management and analysis. Defensive investors, as Graham describes them, should seek out established, financially stable companies with a long history of profitability, low debt levels, and a consistent dividend payout. These companies tend to provide steady returns over time with less volatility. For example, large consumer goods companies like Procter & Gamble or Unilever have historically performed well even during recessions, making them ideal for defensive investors. On the other hand, enterprising investors, those who are willing to dedicate more time to research, can seek undervalued stocks using more advanced techniques. Graham introduces the concept of net stocks, which refers to companies whose total assets, minus all liabilities, exceed their market capitalization. In other words, these stocks are trading at a discount so deep that investors are essentially buying the company for less than the value of its net cash and liquid assets alone. This is one of the purest forms of deep value investing. Graham's research showed that these stocks, while often ignored by the broader market, have historically generated strong returns. However, he warns that these investments require meticulous research and a willingness to withstand market fluctuations. Another critical lesson is the avoidance of speculative stocks that rely solely on hype rather than fundamentals. Graham particularly warns against investing in unproven startups, overhyped IPOs, and companies with excessively high price-to-earnings (PE) ratios without corresponding earnings growth. For example, during the cryptocurrency boom of 2017 and again in 2021, many new investors poured money into digital assets and blockchain startups without conducting any fundamental analysis. While some early adopters made substantial gains, Many inexperienced investors suffered massive losses when the bubble inevitably burst. Graham's approach would have protected investors from such speculation, emphasizing that true investing is based on hard data, financial stability, and a company's ability to generate real, sustainable profits over time. He stresses that successful investing is not about chasing the next big thing, but about making consistently rational decisions based on long-term fundamentals. In the final chapters of The Intelligent Investor, Graham warns about the dangers of relying too much on professional fund managers and stock market forecasts. He argues that even the most seasoned experts fail to consistently outperform the market, and that individual investors can achieve equal or better results by applying a disciplined, long-term approach. One of the key takeaways is that no one, not Wall Street analysts, not fund managers, not economic forecasters, can predict the future with certainty. Graham provides numerous examples of how actively managed funds often underperform simple index funds over the long run due to high fees and poor market timing. This insight laid the foundation for modern passive investing strategies, which prioritize buying and holding broad market index funds rather than attempting to pick individual stocks. For example, Warren Buffett himself has stated that for most investors, simply investing in a low-cost S&P 500 index fund is the best long-term strategy. This aligns perfectly with Graham's philosophy that minimizing costs, avoiding speculation, and focusing on fundamentals are the keys to successful investing. Thank you for listening to this in-depth analysis of The Intelligent Investor. If you found this valuable, make sure to subscribe to our channel, leave a comment sharing your thoughts, and let us know what books or topics you'd like to see in future episodes. Don't forget to hit the notification bell so you never miss an update. Your support helps us continue creating high-quality content to help you become a more informed and successful investor.